It is John A.G. here, and before anything else, I need you to act now and type currency archive in the comments to show you are paying attention. Because what I'm about to explain is the kind of economic reality that gets buried, ignored, or mocked by television pundits who never discuss real structural breakdowns. This channel survives because people like you show up, engage, and prove there is still an audience that wants truth about money, markets, and power structures. So type currency archive now, then stay with me as we break down what may be the most important silver market development of this year. Today, February 27th, 2026, is first notice day for March COMEX silver, and the numbers emerging this morning are genuinely shocking and historically abnormal. As of this morning, 10,526 contracts are standing for delivery, representing 52.63 million ounces. Buyers are demanding physically delivered immediately. Against that demand, COMEX registered vaults hold roughly 86.13 million ounces, meaning 61% of deliverable inventory is claimed on a single first notice day. If you understand commodity markets, you know delivery months are supposed to see small percentages stand for metal while most contracts roll forward or settle financially. What we are witnessing instead is open conflict between physical demand and paper settlement mechanisms. And history shows when these diverge sharply, one side eventually fails structurally. To understand why today matters, we must revisit February 25th, when CME halted metals trading at 12:11 Central Time, citing only technical issues publicly. Natural gas resumed within 50 minutes, yet metals remained halted without timeline, explanation, or transparency, while silver traded above $91 and breaking out technically. When trading resumed, silver was slammed from 91 to 80,498 through 3 consecutive selling waves, erasing momentum and collapsing March open interest dramatically. More than 11,000 contracts vanished in a single session, removing over half the anticipated delivery pressure that analysts expected could trigger historically significant physical settlement demand. This was not unprecedented because November 27th and 28th, 2025 saw a 10-hour halt on first notice day for December silver deliveries. That shutdown, initially blamed on cooling failure, occurred precisely as large delivery demand was building, including reports of a Chinese industrial buyer seeking 30 million ounces. After that halt, silver rallied from $53 to $121.78 within 60 days, a 120% surge driven by physical scarcity concerns. Then, CME raised margin requirements by roughly 50% within 2 weeks, triggering forced liquidations that crashed silver back to $63 rapidly and violently. The pattern now appears consistent. Halt trading, deflate momentum, raise margins, trigger selling, then allow recovery as physical scarcity quietly rebuilds beneath suppressed paper pricing structures. No regulatory investigation has been announced, and no mainstream outlet has asked why exchange disruptions occur exclusively when metals rally near delivery deadlines requiring physical settlement. This is not bearish speculation. It is structural analysis of exchange behavior under stress conditions where delivery obligations threaten confidence in the paper pricing mechanism itself. Now we must examine vault data because this is where episodic events transform into structural reality that cannot be dismissed as coincidence or temporary market dysfunction. Registered silver represents metal assayed, warranted, and deliverable against futures contracts, unlike eligible silver, which cannot be delivered without owner consent and conversion to registered status. In October 2025, registered silver stood near 167.7 million ounces before collapsing below 100 million for the first time ever recorded. That psychological floor had held through every prior squeeze attempt, delivery surge, and crisis year for decades, yet it has now been decisively broken and continues falling. Today, registered silver sits near 86 million ounces, a 49% decline in 4 months, with drainage rates averaging roughly 785,000 ounces daily. Seeking Alpha confirmed the decline reflects metal leaving the COMEX system entirely, not reclassification into eligible inventory, meaning buyers removed physical metal from exchange custody. January and February deliveries alone consumed over 74 million ounces, equal to 86% of today's registered inventory drained in just 60 days of settlement. Delivery rates near 98% are historically unprecedented, compared to normal markets where only 2 to 5% of contracts stand for physical delivery. Such behavior signals profound distrust of paper settlement and a collective shift toward physical possession by institutions, industrial users, and sovereign entities securing strategic supply. London lease rates confirm stress, spiking near 35% annualized versus normal 0.3%, indicating physical holders refuse lending amid price expectations and counterparty concerns. Exchange for physical spreads expanded from 25 cents historically to over $1.10, revealing urgent New York demand and constrained London supply pipelines. Although spreads narrowed after the halt due to reduced delivery urgency, Structural constraints persist because metal shipped westward has not been replenished in London vaults. LBMA inventory data lags 6 to 8 weeks, complicating analysis, yet analysts estimate freely circulating London silver may be only 4,000 tons available. That equates to roughly 129 million ounces, only modestly above COMEX registered levels, highlighting how thin global deliverable inventories truly are today. ETF flows reinforce this trend, with SLV recording hundreds of millions in inflows, signaling institutional conviction that silver remains structurally undervalued despite extreme volatility and engineered sell-offs. PSLV holds over 217 million ounces fully allocated, while retail coin premiums remain 15 to 25% with multi-week delivery delays globally. Now consider Mexico, the world's largest silver producer, supplying roughly 23% of global mine output from regions increasingly destabilized by cartel violence and transportation disruptions. Recent military operations triggered widespread retaliatory violence across multiple states, blocking highways and disrupting refined silver transport from mines to export facilities and vault replenishment channels. Analysts report COMEX warehouses are not receiving expected Mexican shipments, meaning delivery-driven inventory drainage may accelerate rather than stabilize in coming settlement cycles. China compounds supply constraints through export licensing rules implemented January 1st, requiring large production thresholds, reducing refined silver exports by approximately 40% already. Shanghai prices previously traded at significant premiums, confirming divergence between Eastern physical markets and Western paper pricing structures, though domestic processing temporarily narrowed the spread. Meanwhile, Shanghai exchange interventions, including account restrictions and delivery allocation controls, demonstrate administrative management of physical shortages rather than reliance on free price discovery mechanisms. Geopolitical tensions further support precious metals, with Pakistan declaring war on Afghanistan and global risk escalation driving institutional demand for hard assets during uncertainty. Simultaneously, unresolved United States-Iran tensions threaten energy supply routes, reinforcing inflation risks and strengthening the macroeconomic case for silver and gold accumulation. CFTC data reveals speculators remain underweight, while commercial banks have shifted net long, indicating price movements are driven by physical demand rather than leveraged speculative excess. Persistent backwardation in futures curves confirms real metal scarcity, as buyers pay premiums for immediate delivery rather than deferred contracts, a hallmark of tight physical markets. The Silver Institute projects continued global deficits, with cumulative shortfalls exceeding 800 million ounces since 2021, equivalent to an entire year of global mine supply. Mine supply growth remains minimal while industrial demand accelerates from solar, electric vehicles, and AI infrastructure, none of which possess viable large-scale silver substitutes currently. Industrial offtake agreements bypass exchanges entirely, signaling sophisticated buyers no longer trust futures markets to guarantee future access to necessary physical silver inventories. Short-term price forecasts vary widely, yet consensus expects triple-digit silver if $92 breaks convincingly, while downside support remains near $82 technical levels. Backwardation across COMEX and Shanghai overrides short-term technical signals, reinforcing structural bullishness rooted in physical supply constraints rather than speculative momentum alone. The compression of March open interest postponed rather than solved delivery pressure, leaving vault inventories vulnerable to continued drainage during upcoming settlement cycles. If deliveries continue near recent rates, March could remove 40 to 50 million ounces, leaving historically low inventory entering April ahead of May Notice Day. Replenishment prospects remain weak due to Mexican disruptions, London tightness, and Chinese export controls, leaving no clear large-scale supply source to restore exchange inventories. COMEX retains tools such as cash settlement incentives and rule changes, yet these measures erode credibility and historically precede further price rallies as scarcity persists. The central question is not whether physical scarcity exists, but how long administrative mechanisms can delay price discovery reflecting true supply-demand imbalances. Everything discussed today is factual. Inventory drainage, lease rate spikes, supply disruptions, geopolitical risk, exchange halts, and unexplained price suppression events under maximum delivery stress. However, volatility remains extreme, with swings from 71 to 121 to 63 to 90, illustrating how engineered sell-offs can punish poorly positioned participants. Position sizing and time horizon discipline remain essential because structural bull cases unfold over months and years, while short-term price action can be violently manipulated. For physical holders, today's data is fundamentally supportive, confirming scarcity, institutional accumulation, and off-market supply agreements, tightening available inventories further. Retail holders hardened by recent crashes are less likely to sell, creating a structural demand floor that strengthens long-term price resilience despite engineered volatility cycles. Looking ahead to May deliveries, Even conservative assumptions suggest registered inventory could fall to 60 million ounces, an unprecedented level threatening exchange stability. Without significant restocking, the exchange may face scenarios requiring emergency measures that could decouple futures prices from physical markets dramatically and permanently. Historical precedents from 1980 and 2011 show exchanges intervening to protect shorts through rule changes and margin hikes, crushing prices temporarily. The critical difference today is inventory scarcity. Administrative tools cannot create physical metal, meaning prolonged shortages may overwhelm traditional exchange management strategies. Possible outcomes include forced cash settlement, deliverable specification changes, massive EFP transfers, or extreme scenarios involving force majeure and suspension of silver futures trading. Any such outcome would likely trigger physical price repricing, as trust in paper settlement collapses and allocated metal commands substantial premiums globally. PSLV premiums already reflect investor preference for fully allocated silver immune to rehypothecation, signaling growing distrust in synthetic exposure vehicles tied to exchange inventories. None of this guarantees imminent failure. Exchanges have survived repeated stress events, yet current conditions represent the most structurally constrained environment ever recorded. Industrial demand continues accelerating, with solar installations alone consuming massive quantities, each gigawatt requiring roughly 50 tons of silver for photovoltaic production. AI data centers, electric vehicles, and advanced electronics further compound demand, establishing a non-discretionary consumption floor that did not exist in prior silver cycles. At current deficit trajectories, supply cannot meet demand without significantly higher prices to ration usage and incentivize new production and recycling capacity globally. This is why major institutions forecast $100 silver not as speculation, but as equilibrium pricing in a structurally undersupplied industrial commodity market. The fundamental question has always been a timing and mechanism of repricing, and current conditions suggest the discovery process may already be underway. Watch today's CFTC data release carefully. Rising speculative longs could signal short-term overheating, while continued commercial covering would confirm the most bullish configuration possible. Currency Archive exists to document these moments when data contradicts mainstream narratives and reveals structural realities shaping the future of money, commodities, and global power. Today is one of those moments. 61% of deliverable silver claimed, vaults draining rapidly, geopolitical tensions rising, and exchange credibility increasingly questioned worldwide. Subscribe, stay informed, and remain grounded in verifiable data rather than narratives, because the next 30 days may redefine how the world prices physical silver permanently.